How people reduce taxable income through deductions. Many people hear the phrase deducting taxes, but the way deductions actually work is often misunderstood. Tax deductions do not remove taxes directly. Instead, they reduce taxable income, which is the amount of income used to calculate taxes. Understanding how deductions are structured helps explain why they apply to some situations and not others. The tax system separates income into categories. Income earned as an employee is treated differently from income earned through business or self-employment. This distinction affects which expenses may reduce taxable income. For employees, most work-related costs are considered personal expenses. Because of this, deductions tied to employment income are generally limited. For business or self-employment income, expenses are treated differently. Business expenses are costs that are directly connected to earning income. Tax systems allow certain expenses to be deducted because they are considered part of operating the business. Common categories include supplies, equipment, software, advertising, and professional services. These expenses reduce taxable business income before taxes are calculated. However, not all expenses qualify. Tax rules usually require that an expense be ordinary and necessary for income-producing activity. Personal expenses are typically excluded, even if they are loosely related to work. Documentation is central to how deductions are evaluated. Records such as receipts, invoices, and statements are used to show that an expense occurred and qualifies under tax rules. Without documentation, expenses may not be considered deductible. Another commonly discussed area is home-related deductions. Some tax systems allow deductions when part of a home is used for income-producing activity. These rules usually require regular and exclusive use of a defined space. Deductions are often calculated as a portion of household expenses. This can include rent, utilities, insurance, or maintenance, allocated based on space usage. Education-related deductions are another area people ask about. Certain education expenses may reduce taxable income if they meet eligibility requirements. These rules often depend on the purpose of the education and how it relates to income. Not all education costs qualify, and limits may apply. Retirement contributions are also frequently discussed during tax season. Some retirement contributions reduce taxable income in the year they are made. This happens because the tax system treats certain contributions as deferred income. Other contributions do not reduce taxable income immediately, but may affect taxes later. The tax treatment depends on how the account is classified under tax law. Health-related expenses are another category governed by strict rules. Some medical expenses may reduce taxable income if they exceed specific thresholds. Only certain types of costs are considered eligible. Timing also matters. Deductions are usually applied in the tax year the expense was paid. This is why tax outcomes can change from year to year, even when income remains similar. Another important distinction is between deductions and credits. Deductions reduce taxable income. Credits reduce the amount of tax owed after calculations are complete. Because of this difference, deductions and credits affect tax results in different ways. Filing method also affects how deductions are applied. Some people use a standard deduction, which is a fixed reduction in taxable income. Others use itemized deductions based on qualifying expenses. Only one method is used on a return. Ultimately, tax deductions are governed by definitions, eligibility rules, and documentation standards. They are applied through structured calculations, not personal preference. Understanding how deductions are categorized and calculated explains why tax advice often focuses on income type, expense classification, and record keeping. This overview explains how people commonly reduce taxable income within tax systems by describing how deductions work, rather than individual outcomes. This content is for educational purposes only and does not provide tax advice. Subscribe for more finance facts.